Have you ever wondered about the best way to build or rebuild your credit, especially if you're starting from scratch or trying to recover from past financial bumps? You've likely heard about various tools and services out there, and one name that often comes up is Kikoff. But what exactly is Kikoff, and more specifically, is Kikoff revolving credit? Understanding the nature of credit products is crucial when you're on a mission to improve your financial standing. Revolving credit, like a traditional credit card, allows you to borrow up to a certain limit, repay the amount, and then borrow again. It's flexible, but it also requires careful management to avoid accumulating debt. On the other hand, installment credit, like a car loan or personal loan, involves borrowing a fixed amount and repaying it in set monthly installments over a specific period. Both types of credit can help build your credit history, but they do so in different ways and have different implications for your credit utilization and overall financial strategy. So, where does Kikoff fit into this picture? Kikoff offers a product called the Kikoff Credit Account, and yes, this is indeed a revolving line of credit. It's designed specifically to help individuals establish and build their credit history without the complexities often associated with traditional credit cards. Here's how the Kikoff Credit Account generally works. When you sign up, Kikoff extends a line of credit, typically $750, which you can use to purchase small items from the Kikoff online store. These aren't your everyday groceries or gas. They are typically digital products like ebooks or financial literacy courses. The key here is that you're using a small portion of your available credit line, and then you make small, interest-free monthly payments to repay that amount. The most popular plan often involves a payment as low as $5 per month. Now, why is this considered revolving credit? Because as you pay down your balance, that credit becomes available again for you to use for future purchases within the Kikoff store. It functions similarly to a credit card in that respect. You have a limit, you borrow against it, you repay, and the credit refreshes. This constant cycle of borrowing and repaying is the hallmark of revolving credit. The genius of Kikoff, particularly for credit builders, lies in how it leverages the mechanics of revolving credit to positively impact key factors of your credit score. Firstly, by making small, consistent on-time payments each month, you build a strong payment history, which is the single most important factor, 35%, in your credit score. Secondly, because the purchases are small relative to the $750 credit limit, your credit utilization ratio remains very low, typically less than 1%. A low credit utilization, how much credit you're using versus your total available credit, is highly favorable for your score, accounting for 30% of it. Thirdly, keeping the account open and active for an extended period contributes to the age of your credit accounts, 15% of your score. The longer your credit history, the better. Kikoff also reports your payment activity to all three major credit bureaus, Equifax, Experian, and TransUnion. This comprehensive reporting ensures that your efforts to build credit are recognized across the board, which is essential for seeing a tangible improvement in your credit score. It's important to note that while the Kikoff credit account is a revolving line of credit, it's not a general-purpose credit card. You can only use it for purchases within the Kikoff store, and there's no physical card associated with it. This limitation is actually a benefit for many users, as it prevents overspending and helps maintain that low credit utilization that's so crucial for credit building. In addition to the Kikoff credit account, they also offer other products, like a secured credit card, which is also a type of revolving credit, and even rent reporting. But the core Kikoff credit account itself is indeed a revolving line of credit designed with simplicity and credit building effectiveness in mind. With that said, thanks for watching, and until next time.